When you work with us, a sell-side investment bank, we have a fiduciary duty to you to get you the best price, best deal, and run the process as cleanly as possible. The other groups that still might call themselves investment banks, they're really origination groups, buy-side groups, are giving hot leads to the buyer, helping them get the deal closed. Their objective is to get the price as low as possible. When buyers have off-market conversations without intermediaries like us, they want to get a below market deal. Private equity firms really tout this idea of off market deals. They're super charming. They're going to tell you to not be afraid of them, and they're going to rob you blind. You will have no idea that you just accepted a deal that was typically 30, 40, sometimes 50% below what the market was willing to pay for your business. What's the process of working with an investment banker? That's a big question that we get asked, and things we know prospective clients of ours are looking up and trying to understand. What's the difference between all these different folks that are coming at me? What's an investment banker? What's a buy-side introduction? What's a business broker? What do they all do, and what's actually right for you, the business owner? Hey everyone, I'm Oliver Bogner, managing partner of the Advisory Investment Bank. We're a lower middle market investment bank focused exclusively on all things essential services. That means we cover HVAC, pest, electrical, fire safety, plumbing, restoration, elevator repair. If it's an essential service, we know how to sell it, and we know how to get you top dollar for your business and the cleanest deal terms. I myself am a 2 times Forbes 30 Under 30 honoree, 2 times Inc. 5000 CEO. I built and sold 5 different companies that have gone through banker-led processes. I've sold my businesses to private equity firms, competitors, strategics. I've been in your shoes as the operator, and I know exactly what it takes to get the best deal. It's why I started the Advisory Investment Bank. We genuinely believe that Main Street entrepreneurs, Main Street owners deserve those Wall Street level outcomes and deserve that Wall Street level white glove service. So if you've ever wondered what happens when you hire an investment bank, this video is for you. Because selling a business isn't like selling a house. It's a process. When you do it right, it's a process that can add millions and millions of dollars to your outcome. So today I'm going to walk you through step by step what it's like to work with a banker, how the process unfolds, and what you can expect from start to close. So number one, it all starts with a conversation. We call it discovery. You might have gotten an email from us, a phone call from us. That most likely was someone on our business development team that was looking in your industry, looking in your market, hoping to talk to business owners that were interested in understanding what their business was worth and get a sense of what's happening in the market. That's a discovery call. Most likely, I'm not going to be on that call, and neither are my partners. That's a discovery call with someone from our business development team that wants to learn about your business, understand revenue, margins, service lines, leadership team, customer base, and get a sense of what makes your business special. Once they understand that, they then talk to the partners, talk to the client services team, and get an understanding of if we actually think there's a real buyer for your business based on the information that we have. And we'll set a follow-up call with a partner, with a leader from the client services team that's going to better understand your business. We're going to talk about some of the similar things again, but really double click on revenue, margins, service lines, customer base, and get a sense of your story. So before we even kind of double click on numbers, we really want to understand that story. And if we think there's a fit, we'll move to a formal engagement agreement. That's an engagement letter that basically says we're going to get X percentage of the sale price when we take your business to market and find you a buyer. We only get paid on the same day you actually get paid. We do not believe in charging retainers. We do not believe in charging fees for us to do a pricing analysis. A lot of lower middle market investment banks want to charge you some sort of Q of E fee where they're coming up with some sort of number for your business doing an analysis. We do that all on spec. We only get paid the day you get paid. We think it fully aligns incentives and holds everyone accountable. That's how we stay 100% aligned with clients like you. We also only work sell side, meaning we only represent the founders of the businesses. We're never representing the private equity firms, the buyers, the platforms, right? We are only working sell side. And I'll explain a little different of what that means to be a buy side advisor versus a sell side advisor. All we do is sell side. Part 2. Next comes the valuation. So we're going to take a deep dive into your financials, much deeper dive than just the conversations. We want to look at your tax returns, your P&Ls, your AP, AR aging, payroll, add backs, and we've got to come up with something called the adjusted EBITDA. So the EBITDA is a key metric, and it's something that your CPA pays your taxes off of, right? So when you file your taxes, they're trying to come up with that EBITDA number. We're trying to come up with the adjusted EBITDA number. So your accountant's trying to charge back everything possible. Even if it's a little gray, they're trying to charge back everything possible to get that EBITDA number as low as possible. We're trying to come up with an adjusted EBITDA. So we're looking for the $100 bills and the seat cushions, and we're adding back everything that was the one-time non-recurring expense, not core to the business, a personal expense. This is not what's on your tax return. We're coming up with that adjusted EBITDA number. What would be your true go-forward profitability? Businesses are sold based on a multiple of adjusted EBITDA, not true EBITDA. We are not valuing businesses, and buyers are not valuing businesses off of what's on your tax return. That is a myth. That is not correct. We know some buyers are telling owners that. That's why you have a group like us involved, right? We're valuing you off of your adjusted EBITDA, and that's what we're going to present to the market. So it's really critical that we come up with an adjusted EBITDA that we know can pass what's called a quality of earnings, the Q of E, which I'll explain a little later what happens. So we're benchmarking your business against recent comps, active buyers, your peers. What are other groups that are doing HVAC, plumbing, pest, landscaping, fire safety, or whatever essential service vertical you're in? We're trying to understand where you stack up, where your margin is versus rest of market. By this phase, we're going to say this is what we believe the business is really worth, what we think the market's going to pay on both a good day and a bad day. Now we put together the marketing package. We build the story. We create the confidential information memorandum, which we code word as the SIM, and you'll hear our team talk to you about this as more or less a book report on your business. Basically, it's a detailed overview that tells buyers who you are, what you built, what the business is going to do, what the future holds, and what the financials look like. This isn't fluff, it's a detailed strategy on where the business is and where we believe it can go. So a great sim makes buyers really believe in the future potential, not just the underlying numbers. But the sim absolutely does break down the underlying buyers. At this point, we also prepare a detailed buyer list. Now, we don't post businesses on business listing websites. We focus on going after strategic buyers only. We're not big believers in search funds. We're not big believers in SBA buyers. We believe that the cleanest deal for our client ultimately is with a lower middle market private equity firm and typically one of their industry specific platforms. Those are groups that know how to do M&A, do these every single week, have motivation to get more deals done in the sector, and can get a deal done quickly, efficiently, and on really solid terms. Typically, a platform buyer is willing to pay a whole lot more than an SBA buyer or an individual that doesn't have any sort of infrastructure to put in place. Number 4, the market process. So this is where the magic really happens. We reach out confidentially, meaning no one in your company is going to know, no competitors are going to know, no customers are going to find out you're selling, no employees are going to know. We reach out confidentially to the market. If you're an HVAC owner, there's 145 active private equity-backed platforms in the US rolling up HVAC, plumbing, electrical businesses. If you're a landscaping business, there's 90. We know exactly who's in the market. We know what they're looking to do. We run a controlled auction process. We go to the market with the SIM. Typically within 3 to 4 weeks, we're going to start to see what are called IOIs, which are indications of interest, basically preliminary offers. We then shortlist that group of buyers, typically bring that list down to 4 or 5, maybe up to 10 buyers who are going to move into management meetings where they're going to meet you. They're going to tell you their story because they're going to sell you on why you should actually accept their deal, and we're going to see if it's a fit. These management meetings are really important where we see who's the best fit for the client, not just financially, but culturally. These management meetings are critically important to really get our clients comfortable and the buyers comfortable with the deal. This is the first meeting. Sometimes these are virtual, and a lot of time these are in person as well. Step 5, negotiation, LOI, and diligence. So once you've met the top buyers, we're going to ask for final bids, which are called an LOI, letters of intent. And then we're negotiating the LOIs. The LOIs are not the APA. They're not the 50 to 100 page contract. These are the key deal terms, formal offers, key deal terms. What are the key deal terms? Initial purchase price, enterprise value, structure, rollover, stock, earnout, all those key deal terms are negotiated at this point. This is where we show you what we're worth. We're going to show you exactly what the initial offers were, and then we're going to push to get the deal to be much better. We're going to push for structure, terms, earnouts, negotiate working capital, all the things that separate an average deal from a great one. Once you sign the LOI, the buyer enters what's called due diligence. That's where they're going to verify financials, legal, HR, operations, and we quarterback that entire process. This is a very complicated process. Usually it's 60 to 90 days. One of the most critical part of these processes is what's called the quality of earnings, which is basically a third-party firm, typically an audit firm. The big guys all do this. The EYs, the Deloittes, are going to do what's called a quality of earnings report on behalf of the buyer. And they're going to double check our work and confirm that all the adjustments are proper and that the business can actually exist on a go-forward basis based on what we've represented. They're confirming customer relationships. They're going line by line, bank ledger by bank ledger, to rebuild typically 3 years worth of financials. That happens in the due diligence period. Typically, diligence periods are 60 to 90 days, and the buyer has an exclusive window to close the deal. We've already picked the buyer. We picked those typical, the best deal terms. We've already negotiated it out, and then they're going to do what's called the Q of E. Then, sometimes we have retrades. This is where the buyer has now fully understood what they're buying. Typically, once the Q of E report is done, which is 30 to 45 days post-signing of the LOI, the buyer's going to come to us and say, here's where we actually think the price is going to net out. We like what we see, or we have concerns off of the Q of E. Sometimes they love what they see, and they go, this is amazing. We actually think we're underpaying. We need to revalue the price and bring the price up. A lot of the time, and this is not indicative of every buyer, but the buyer is finding issues. They're finding that there's customer concentration risk. They're finding that certain bills aren't being paid. They're finding that certain employees aren't specific to the business, right? More or less, they're finding that the EBITDA is actually lower than what we presented. And again, we do everything in our power to ensure that adjusted EBITDA will stand up during a Q of E. But sometimes there's going to be a debate and questions, and we have to defend why we did that in the Q of E. There's also going to be normalizations. This is something that really drives up or down the quality of earnings and ultimately the adjusted EBITDA that the buyer's underwriting. If you are leaving the business, there has to be go-forward comp for that operator. If you don't have, let's say, an APAR collections person and you're doing collections yourself, you have to normalize for what that role entails. If you are not a branch manager or you don't have a branch manager, we have to normalize for what that go forward comp is going to look like. And that's all factored into what the true kind of V2 of the Q of E post adjusted EBITDA looks like. If we're all aligned, and again, we really want to get everyone aligned. That's our job. The buyer doesn't want to lose the deal. We quarterback this entire process. Then it moves into legal, HR, operations, more in-person meetings, and getting teams really teed up for what that closing and that integration is going to look like. Finally, closing, celebration, closing day, wire hits your account, you shake hands, or we do a Zoom wave with the new partners, and just like that, your business, your life's work has transitioned into that next chapter, and we love, love, love those moments. Our role doesn't end there. We stay involved as much as you need us post-close to ensure the integration goes smoothly, earnouts stay on track, because for us, it's not just about closing the deal, it's about creating a great outcome for Main Street founders like you. I think I've explained why this is complicated. And if you want to know more about these intricacies that go into actually getting a deal closed, please reach out and we will walk you through it line by line. Having an investment banker that understands what these Wall Street guys are looking for is critical. There's other paths you can go, but we really can give you reference call after reference call, where clients will tell us that we are worth our weight in gold and that fee they paid to us, they were able to get 5 to 10 times that value based on how we were able to radically impact the deal. So a lot of essential service business owners are getting called directly by buyers. They might be getting called by the buyer themselves or getting called by a group that typically is a buy-side group. So they're kind of us in reverse. They get paid a percentage based on you accepting the buyer's deal, and they do try to handhold that process, but they do not have a fiduciary duty to you. They do not represent you. They represent the buyer. When you work with us, a sell-side investment bank, we have a fiduciary duty to you to get you the best price, best deal, and run the process as cleanly as possible. The other groups that still might call themselves investment banks, they're really origination groups, buy-side groups, are giving hot leads to the buyer, helping them get the deal closed. Their objective is to get the price as low as possible, even though they're not going to tell you that. When buyers have off-market conversations without intermediaries like us, they want to, I'm not going to say steal the business, but they want to get a below-market deal. Private equity firms really tout this idea of off-market deals. They literally tout this in their fundraising when they're going to market to raise more money through their LPs. They're saying, this is how many off-market deals we were able to get. This is how many off-market deals our portfolio companies and platforms were able to acquire. It's a key selling point, and it means that they're really good at origination, good at selling business owners. They're super charming. They're going to tell you to not be afraid of them, and they're going to rob you blind. You will have no idea that you just accepted a deal that was typically 30, 40, sometimes 50% below what the market was willing to pay for your business. So again, challenging. The other path are there groups that are business brokers, and we don't think business brokers are bad, but business brokers don't typically understand what's happening with Wall Street's obsession with essential services and what's actually able to get your price high and how these Wall Street guys make money. This is what we know. We know exactly how they make money, and we're able to use that to our advantage for our clients to get the very best price. Business brokers don't understand what's happening with these platforms and how they're aggregating like businesses, similar businesses in the same market, complementary businesses to get this EBITDA arbitrage, right? So how a buyer makes money on your business, which we're going to do another video on that. But a buyer makes money on your business because they're marking up the price in their portfolio. They know what the overall platform is worth versus the individual asset. So in HVAC business, let's say it's a $20 million EBITDA HVAC plumbing electrical platform that's doing $100 million top line, $20 million bottom line. That business is probably worth, on a bad day, between 12 to 15 times. So we're going to do the math. 20 times 15, that business is worth $300 million from an enterprise value standpoint. Now, if you're a little baby HVAC business, let's say you're $1 million of EBITDA and $5 million of top line, they're going to try to acquire you. If you're running a process, again, depends on a whole lot of things, but your business is probably worth a minimum of 7x, a high of maybe 8, 9x, right? So let's do the math, right? Let's say you sell it to them for 8x. You sell it to them for an $8 million enterprise value. That $8 million to you is suddenly worth $15 million to them. Day one, no synergy, no merging of buying power, no merging of HR. Just on paper, it's already a $7 million gain. We understand that, and that's why we use that to our advantage to create competitive auction processes to get the private equity firms to step up to the plate and give you the very best price on the best deal terms. I would encourage you that when you're talking to potential advisors, you really ask them these questions and you really get to know, do they understand what's happening in your market? Because I can tell you as an essential service business owner, everything that's happening around you, who's buying in your market, what they're trading at, what they want to buy more of, when they're looking to sell themselves. I can tell you all those things because we're an investment bank. So again, our mission is to truly defend Main Street against Wall Street. That is our mission. That is for our reason for being, why we exist. We exist to defend Main Street business owners against Wall Street tycoons. This is why we exist. So the best deals don't happen by accident. They happen through process. Hopefully you saw that. This was a long video, tons of information. Feel free to reach out with any questions, concerns, anything specific you have where you want to double click on what was talked about in this video. Again, I'm Oliver Bogner from the Advisory Investment Bank. Really excited to get to know you, get to learn more about your business, and we'll chat soon.